Hi folks, this is Zoom Out with Toadza Says, and this is my 2025 Q3 Outlook. As per usual, this presentation is for your entertainment only. It's not investment advised. Remember, I'm biased and have blind spots, so definitely do your own research. First, let's do a quick recap of what happened in Q2. It started April 2nd with Trump launching the official tariff war on Liberation Day. 7 days later, he put a 90-day pause, but escalated a war with China to 145% tariffs on China. Then there was a trade truce between the US and China on May 19th. Meanwhile, we had India and Pakistan starting a shooting war on May 10 with a ceasefire agreement on May 14. Soon after that, the bromance breakup between Elon Musk and Trump started around June. Then Israel had the surprise attack on Iran, leading to a massive escalation in kinetic warfare in the Middle East. Then we got a ceasefire on the 24th after the US bombed Iran on June 21st. Meanwhile, the NATO summit could have gone horribly, but it went nicely on June 25, with Europe essentially agreeing to pay 5% of their GDP for defense. And finally, we had the One Big Beautiful Bill passing on July 4th. Now, with so much mayhem, uncertainty in the global economic order, on top of that, with wars sprouting up left and right, you would have imagined that the second quarter could have been a terrible 3 months for the stock market. What was interesting, though, is basically the stock market bottomed on tariff day and then rebounded pretty strongly for the last 3 months. Why is that? Meanwhile, just charting how Bitcoin has performed over the years so far, what's most interesting to me is you imagine Bitcoin to be extremely volatile, but from the time that Trump announced the tariff wars, we saw the Bitcoin actually only dropping about 12% compared to almost 20% in the stock market. And the rebound from that point has been an amazing 60%. Given the craziness geopolitically and economically with all the new Trump policies, you would imagine the markets would be poor. However, this is a chart that I always keep liking to share with you. I keep talking about global liquidity. Here's the global M2 with a 12-week lead. So it's a 3-month lead. And if you track that with Bitcoin or with the stock market, it seems to be a very strong indicator of the next quarter's performance. So here we have the black line indicating that liquidity is still rising and it will continue to rise into the fall. After that point, we'll have to see how things develop. Will it keep rising? Will it go sideways? Or will it peak out and start to roll over and go down? In the meantime, for the next 3 months to 6 months, it's likely that risk assets like Bitcoin, like the stock market, will continue to perform relatively okay, short of a natural disaster or a major war. If you remember, the GDP of the US was a negative, I think, 0.3% in Q1. This had a lot to do with the fact that we were just importing massive amount of goods in preparation for tariffs. Well, that is rebounding, and Q2 looks to be a pretty solid 2.4, 2.5% GDP. So the main point here is I don't think we're anywhere near a real recession, and we'll talk more about that later. A final 2 points of what happened in Q2. First is the US dollar. From the beginning of the year, the dollar was weakening, but it really had a precipitous drop after Trump's tariff wars began. So the red line is showing the US dollar compared to a basket of the main currencies around the world. The blue line is the 10-year US Treasury yield. This is a specific target that Trump and Bessent have made clear that they are focusing on. They want that blue line to go down. And what has happened is it's actually gone up. So the historic correlation between the dollar and the 10-year yield, it's suddenly been broken. I think there are many reasons for that, but I think the most important thing is that the relationship doesn't seem to hold anymore. There are political, geopolitical factors that are influencing how people view the dollar and the US treasuries. How this evolves will be hugely important for the U.S. Economy, our development, trade. It's vitally important to watch this to figure out how to invest. So here we are, crystal ball for the second half of 2025. First, I think the effect of tariffs is going to cause a rise of U.S. inflation. If you remember in my last outlook, I did mention that I thought inflation would go down and go sideways, but come the summer, the real effects of inflation will show up in US goods, and I think we're starting to see that. We're going to have to watch over the summer if this continues to go up, but current Wall Street estimates with current Trump tariff negotiations, we're probably going to end up between 15 and 20% overall on average tariff inflation across the board. And that will definitely affect prices and impact consumer spending. Second, I mentioned I think U.S. unemployment will remain anchored around 4%, primarily because Trump's immigration policy has taken a large chunk of the labor force out of the United States. So we have a smaller labor force doing the same jobs. Probably wages continue to remain stable, if not rise, and the employment rate remains a healthy 4%. In the tech sector, item number three, AI is disrupting big tech employment. You're seeing big tech companies uh, with big layoffs. I think they're boosting productivity. They're using AI in their corporate operations. This has a small effect on unemployment, but it has a big effect on the outlook and sentiment of the American workforce. Number four, I did mention, I think the US dollar has been weakening. It weakened over 10% at the peak, and it's been rising recently in July. I do think we get a short cycle of US dollar strength, perhaps for the next couple of months, but overall, the bigger trend is still for the dollar to continue to weaken, primarily because of how the world feels about America, also, because Trump and Bessent have this as a directive that they want to use the dollar to weaken in order to help boost US exports. Number six, I think Powell doesn't get fired, although there's a lot of pressure on him. I do think that a shadow chair will be announced by Trump in short order. He wants to install somebody that is more to his liking, who will be a proponent of cutting interest rates. This will be a distraction and a divisive factor in the Fed. However, I want to remind everybody that the Fed is a committee. The body that decides on the actual changes in interest rates and Fed policy is a committee of several members. And it's important to note that in the last few meetings, everybody is fairly unanimous in keeping interest rates where they are. There are a few people who are trying to curry some favor with Trump, who have been vocal about perhaps trying to cut rates soon. I don't think that's going to happen for July. The earliest window would be September. However, that will be extremely data dependent. So over the next few months, if we start to see US inflation rising again, and primarily that will be because of tariffs, we won't get any cuts. And that's just what will happen. Meanwhile, around the world, I think the EU economy has bottomed and is starting to gain some traction. There's fiscal stimulus coming in terms of defense spending and other infrastructure spending. They've already lowered rates and they probably will continue to do so. In China, we're seeing stimulus, liquidity injections, fiscal stimulus, new projects on high speed rail, et cetera, et cetera. Around the world, because of the Trump effect, you're seeing countries decide to spend money, take on debt, and try to avoid the worst part of a real trade war. Number nine, what's been obvious over the last 3 months, US assets are no longer the most attractive in the world. Though I don't expect the US markets to collapse, we still have some amazing assets, investments. But now people are saying, yeah, we've done really well in the US. Trump is against foreigners. International markets are cheap and they have stimulus coming. International assets are gaining favor with investors, and we definitely want to pay attention to that. Finally, as I mentioned, I showed you the global M2, global liquidity. We are getting we got an increase in the first half, probably peaks out in the second half. And then we have to kind of watch to see how governments decide and what policies they decide to either stimulate or, let their stimulus kind of run sideways. Basically, despite the global disorder, despite shooting wars and trade wars and all of this stuff that should be a major headache and take risk appetite away, we're seeing risk assets still performing well. And one of the underlying fundamental reasons is there's liquidity provided by these governments that keep things floating. The moment this liquidity starts to drain, we definitely want to pay attention and become much more conservative. Getting a little bit more granular, here's my outlook on each of these indicators. Inflation, unemployment, retail sales, I think, start to decline. U.S. real estate has not done well. It's pretty clear. The permits, building, sales have all declined with high interest rates, high mortgage rates. Consumer sentiment is not good. CEO sentiment probably has bottomed because they've experienced the worst of the uncertainty with the trade war. However, they're not either bullish or building new factories quickly either, with the exception of AI and some of the defense sectors. Trump austerity in this first year of his office, increasing tariffs, really removing illegal immigrants, uh, putting student loans back on the consuming population. These are all measures of austerity that is going to reduce spending and economic activity. To counter that, Trump has really pushed forward his one big beautiful bill and locking in the tax reforms that he had already set up. We're going to get some tax breaks. This is a form of fiscal stimulus that will show up in the U.S. economy, but probably not until 2026, as you don't have to pay taxes on your tips up to a certain level, but that's for when you're reporting your taxes. So that's a next year thing. Rest of the world stimulus is still going strong for this year and probably into the next year. And as I mentioned, the dollar, I think we have a brief cycle of strength and then we resume the down cycle of weakness. And just to reinforce some of my thoughts with some data, here's the Atlanta Fed's sticky price consumer price index, their sticky price inflation. They're seeing things rising up to 4.3%. And it's a different way of looking at inflation, but Atlanta Fed has been on the cutting edge of new ways to look at economic numbers. Worth noting. I do want to highlight that the inflation calculation is like 40 some percent is based off shelter costs, shelter inflation. And we're seeing shelter inflation finally come down from multi-year highs. This will pull down the inflation number on the official calculation. That's good and bad, but it's worth noting that we probably won't have skyrocketing inflation in the 5-6% range, but I do believe it will remain elevated above the 2% target. Specifically, within the shelter inflation part, you're seeing condo prices drop like a rock. You're seeing this across the board, but this is a very strong highlight of certain states have immense overbuilding, over inventory. They're not selling through. Prices are starting to come down. That's very different. And this is a sector where construction employment is actually a very major factor in U.S. employment. So we'll see if this starts to show up in unemployment as well. Very messy chart, but there's a clear indication that tariffs are starting to show up in prices. And this study is showing that they're popping up. Amazon has shown some price increases, especially for lower price items. And we're going to see more and more of this filter up. What's important is there was a survey by Apollo where they estimated 70% of tariff impact price increases will be directly passed on to consumers, and maybe 20% will be eaten up by the corporations or reducing their profit margins. We're going to see this show up more and more in the second half of the year. And with all the trade negotiations delayed again to August 1st, we still have a lot of unknowns. And is there a 200% tariff coming for pharmaceuticals? Will Trump keep the 50% tariff on copper or Brazil? It looks like the Trump allies in Asia are going to end up with 25, 35% tariffs. We don't really know. What you're seeing Wall Street do is kind of ignore it until it really crystallizes and then react to it. But I think it's fair to say that tariff uncertainty is not done. And just a quick chart, hard to read, but Chinese liquidity, their fiscal stimulus, they're really turning on the money printers. They're trying to keep their economies running. They announced a 5% GDP growth. Nobody believes it. Anecdotally, you hear a lot of pain and suffering, people taking second jobs just to make ends meet. So all this tariff war is having an impact on China. Um, but who's going to hurt more? We'll find out. And if they come to some agreement, I think Trump and China, he's working very hard to get a meeting with Xi Jinping to try to calm things down, and that may still evolve. As I mentioned, the dollar bottomed and has been actually strengthening recently. There's speculation it may get back up on the DXY dollar index back to 96 or 98. Let's watch that. I think that if it hits those levels, it does want to start to weaken again, and we may have another weakening cycle. Very important to how we invest. As the dollar weakens, we definitely need to look at international investment opportunities, and we need to focus on US companies that are focused on exports, as well as the domestic company that are, able to control their prices. So that's where we're looking for domestic and international stocks. Again, another data point of the dollar weakness, but also coinciding with central banks. Essentially, aside from the Fed, which hasn't reduced much, everyone else, every central bank around the world is basically on a lowering interest rate trend. Don't know how far that will go, but they're trying to stimulate their economies in order to make up for some of the challenges that the trade wars are going to cause their economies. Now for some geopolitical risks. I have outlined 4 here, but I think these are hugely pivotal, though it's hard to invest one way or the other with it. Hard for me to make a prediction. I just know that these are very critical factors that we need to have in mind so that if something happens here, we're able to react quickly. The first will be talking about Xi Jinping, the leader of China. Second, US dollar shortages around the world. Third, Chair Powell and whether or not he's able to stay in his role. And finally, I'm concerned about terrorism. Recently, there's been big buzz about Xi Jinping and losing power. So this is vitally important because obviously negotiations with the US, control of the country, is there going to be infighting, a political war within China? These are hugely important as they affect the global order. My uncle in Taiwan and his group of friends believe that Xi Jinping fell ill and therefore missed some important meetings that he normally would go to, and is now preparing for his transition. So he's relinquishing some of his power, setting up a successor organization. He believes there's a smooth transition. Other people, other China watchers, are a little bit more concerned as they've been watching video footage of public meetings, looking at the body language of certain players, and they're very concerned that there's a real significant infighting, that there's the Hu Jintao faction now gaining power and trying to take over more power. They've apparently, it's rumored that they've installed another committee that sits above Xi Jinping now in order to make official government policy. In this slide, I have a couple of names of people who are potentially up and coming risers in this power transition. If this is the case, yeah, we'll watch out for that. My concern primarily is whether this is an orderly or disorderly transition. If there's real infighting, it could get nasty, and there could be anything to do with keeping power and surviving in the politics. I could imagine generals or Xi Jinping needing to rally the country and perhaps doing something kinetically aggressive against Taiwan. If it's an orderly transition, that would be a much better scenario, much more relief to the rest of the world. Um, Hu Jintao faction is a little bit more market friendly, so that would be a positive for the global order. So we need to keep watch and be vigilant about what's happening in China. This will affect the world and peace or war. It's a very important strategic factor. This point is a little bit wonky, but bear with me. Recently, the Bank of Japan has intervened in their currency and their bond markets, and this is a big deal, okay? Because internally, Japan's politics have also been shifting. Prime Minister Ishiba is losing power. Recent elections in Japan have seen the rise of a Japanese first party. So policy direction and economic stimulus, all of these things are now in flux. There's a lot more uncertainty related with Japan that's affecting their bond markets and their currency. Now, this kind of move by the Bank of Japan hints at global demand for dollars, that it's rising, that there's more need of it. And given that in Q3 and Q4 of this year, there's a lot of dollar denominated debts around the world, especially in Asia and in emerging markets, that need to be refinanced. So there could be, again, demand for dollars. What's concerning is all this stuff links into currencies and something we call the carry trade. For example, in Japan, the interest rates are still, I don't know, 1%, super cheap. People borrow in large quantities and then they convert it to dollars and then they buy US investments and assets. And that's all wonderful when the dollar is strong. When the dollar weakens, the carry trade reverses. People sell their investments in order to generate cash and in order to pay back their loans. So in past history, including last year, when the carry trade is unraveling, it usually causes a big market drop, especially in the US, as most of the assets have been borrowing dollars to invest in US assets. When that reverses, we can get a market drop that's pretty sudden and precipitous. Sorry, my head's in the way of the chart, but it looks similar to the one that we saw earlier, where we see the 10-year yields hovering around 4.5% while the US dollar has weakened. The point here being Powell. Trump really, really wants the Fed to cut interest rates. He believes this is extra stimulus. It'll get the country through other economic slowdown and challenges. The Fed's mandate is not that. It's about unemployment and inflation. So Powell is actually following to the T the directive of why this agency was created. What's important is Trump has been talking about getting rid of Powell, whether firing him or urging him to resign. As I mentioned, a shadow Fed chair may be selected and installed earlier than has historically been done. Um, in the event that, for whatever reason, Trump is able to actually fire the Fed chair, the market reaction would be terrible. He announced some rumor about that a couple, I think last week. The market reacted very negatively, and then Trump came out and said, "No, no, we're not likely anytime soon." I suspect that was just testing the waters to see if he can get away with it. It's fair to say Fed independence is very important to the financial world, to Wall Street. Nobody wants him to touch Powell. It's a bridge too far, and I think Trump realizes that. So uh, the concern right now is there's been a lot of noise about the renovation of the Fed buildings, that it's over budget. It's 2.5 billion now. This building has not been renovated since it was built. So I don't know, 100 years. It's due for something, and you've got to build it the right way because it's the central bank of the United States that controls the financial system of the world. Um, However, you're going to see Congress people picking at it and trying to make a case for Powell being either lying or incompetent. So we're still going to see this noise, I think, for the second half of the year, and we'll see how this affects the Fed and Chair Powell. Having said that, in the event that Powell is removed from office forcibly or by resignation, you should expect a dramatic impact on the dollar and US treasuries and probably the entire US economy. So it's not something to wish for, but I want to make you aware of it. Finally, I'm concerned about terrorism. So the US struck Iran's nuclear facilities, uh, project incomplete. For one, I think there's still missing material, enough material to make about 10 nuclear weapons. And then the facilities, there's a lot of dispute about whether it really actually damaged their facilities. So whatever side we see, we can't verify from here. I think what's important is it's not crazy to think about dirty bombs. If you can get these materials out and place them in a suitcase somewhere in downtown, Seattle, it won't cause the devastating nuclear weapon destruction, but it will definitely be a very easy way to kill thousands of people. So going forward, I think we need to be a lot more vigilant about this, and this could happen at any time, anywhere around the world. And we need to be very cognizant that this was and can be triggered by Trump's actions involving the U.S. in the Middle East. And we will definitely be, we're the big devil, Israel's the little devil. We're going to be targeted. So everybody keep watch of some random event like that happening in the next few years. So here we go. Here are my investment themes for the second half of 2025. First, with global liquidity still rising into the fall and probably to the end of the year, I think stocks and risk assets are still going to outperform bonds and real estate. Second, the dollar weakness indicates that we should look outside of the US for great opportunities. So I think international could do better than the US. Third, within the US, what should we invest in? AI enhanced sectors are still very attractive, high growth. The AI build out is still booming. You're seeing companies that are involved in AI employing their own AI and becoming more productive. This is going to spread to other corporations, and we could see productivity growth within the industry. Four, I think gold, Bitcoin, crypto, stable coins deserves a place in the portfolio. It is still in a global order of reduced trust between countries. These are agnostic and not controlled by any one country. They will continue to attract interest while the global order is falling apart. Five, I think the sectors to look out within the US specifically, tech and industrials, those are Trump policy tailwinds. Financials, energy, I think they'll do okay, but they're not controlled either way. They will be, how we would say, dependent on how the economy rolls. And I think the economy slows. So they'll do okay, but not great. I think healthcare and consumer spending sectors are going to face some tailwinds. I think healthcare with Trump's action towards potential tariffs, all that stuff, Medicare reform, these are going to start to hurt and won't be very productive in earnings reports. Number six, globally, I think global defense, commodities. Then I favor exporter nations versus importer nations. So the countries like Brazil or Chile or Argentina that export a lot of their goods probably going to do just fine. But the countries that have to import a lot of energy and raw materials, they're going to have to balance that and probably not perform as well. Finally, income. I think income is growing to be a little bit more important. If the economy slows, having some regular cash flow generated is a good idea. Again, I'm looking internationally, emerging market debt. I'm also looking at new alternative investment ideas, callable notes, option writing entities. There are a lot of things out there that are generating high levels of income. So in a nutshell, that's kind of where I'm looking. I think overall the markets are in the US will be at least sideways, if not a little bit up with the liquidity. We definitely want to start to pay attention towards the end of the year and into next year, whether that liquidity is still going to be there. Um, definitely need to expand the portfolio to be a little bit more global. And there are certain global themes that every country in the world is going to spend on, like defense and like rebuilding their infrastructure. So these are tailwind sectors, I think, that have a few more years of growth. So that's all for now. Thanks for watching. If you have any questions or comments, feel free to reach out. Happy investing, enjoy your summer, and stay safe.